Hey, welcome to The Explainer. Today, we're going to dive deep into the engine room of basically every successful business out there, corporate finance. So let's just jump right in. All right, just imagine this for a second. You've just come up with a brilliant idea for a new business. Let's say it's an online service, something like web design or digital marketing. You can see it all so clearly in your head, right? You're ready to build something amazing and, yeah, of course, make some good money doing it. But, and there's always a but, right? Here's that first big hurdle. Even the best ideas in the world need some fuel to get off the ground. I mean, you're going to need to hire people, maybe buy some software, invest in marketing, and all of a sudden, you're slammed with two huge questions. First, where on earth do you get the money? And second, once you actually have it, what do you do with it? And that, right there, is exactly what corporate finance is all about. It's not some dry, boring thing just for accountants, no way. Think of it as the essential toolkit for answering those really crucial money questions that every single business, I don't care if it's big or small, has to face. And you know what's really fascinating? This whole seemingly complex field, it really just boils down to three fundamental decisions. That's it, three. And if you can get these right, well, you are well on your way to building a really sustainable, valuable company. Okay, so let's break down those three big decisions. You can think of these as the core questions that every single financial manager out there has to wrestle with day in and day out. All right, first up, we've got the big picture question. So for our little online business idea, this might sound like, hey, should we invest a bunch of money in building our own custom software platform? Or maybe, should we go out and buy a smaller competitor? You see, these are the real game-changing decisions about where you're going to put your money for long-term growth. So this whole process has a name. It's called capital budgeting. And the core idea behind it is actually pretty simple, but it's super powerful. A financial manager is always on the hunt for investment opportunities where the value they're going to generate is way greater than what it costs to get them. It's really all about making smart bets on the company's future. Okay, so let's say you've decided, yep, we're going to build that amazing new website. Great, but that immediately leads to the second critical question. Where is the money actually going to come from to pay for all that? Well, this is what we call the capital structure. And basically, you've got two main choices. One, you can borrow money. That's called debt. Or two, you can use your own cash or sell off pieces of the company to investors. That's called equity. And believe me, each choice comes with its own big set of pros and cons that totally affect the risk and the value of your business. So you might see a company that's financed with, I don't know, maybe 70% equity and 30% debt. But that mix is never, ever random. A good financial manager has to constantly weigh the options. Like taking on more debt might be really cheap if interest rates are low, but whoa, it also ramps up the risk. Finding that perfect sweet spot, that perfect balance, that's honestly one of the most important jobs in all of finance. And that brings us to our third and final question. This one zooms in from that long-term, big picture vision right down to the nitty-gritty of daily operations. To put it simply, how do you keep the lights on and pay the bills day in and day out? This is what's known as working capital management, and it is all about managing that short-term cash flow. So for our online business, it's asking questions like, do we have enough cash right now to pay our freelance designers this week, even though our biggest client isn't going to pay us for another 30 days? It's that constant, day-to-day financial juggling act that literally keeps a business alive. All right, now running right alongside those three big decisions, there's another absolutely crucial choice you have to make right at the very beginning. How are you going to legally structure your company? And this is a big one, because this decision impacts everything from your personal risk all the way to how you get taxed. You can basically think of it as a trade-off. On one side, you've got these simpler structures, like a sole proprietorship or a partnership, but they come with a major risk. And on the other side, you've got the more complex corporation, which offers a really powerful form of protection. A sole proprietorship is, by far, the simplest way to go. You are the business. It's super easy to set up, and you get to keep all the profits. But here's the giant catch: unlimited liability. And what that means is, if the business gets into debt, your personal assets, I'm talking your car, your house, they're on the line. A partnership is pretty similar, just with two or more owners. So you get more brainpower, more capital to work with, but that critical disadvantage, it's still there. General partners still face that same unlimited personal liability for the business's debts. And this is where the corporation changes the game. You've got to think of a corporation as a completely separate legal entity. It's almost like a person in the eyes of the law. This creates this protective wall, giving the owners limited liability, which means their personal assets are safe. So what's the trade-off? Well, it's more complex, and there's this thing called double taxation, where profits can get taxed at the corporate level and then again when they're paid out to the owners. So with all these complex decisions and different structures flying around, you might be wondering, who actually manages all this stuff as a business starts to grow? Well, let's meet the key players. Okay, so in a larger company, this whole world falls under the Chief Financial Officer, or the CFO. This is the top financial brain in the entire company. And reporting up to the CFO, you typically have two key roles that split up the financial duties, the treasurer and the controller. The easiest way to think about the treasurer is as the company's banker. This office is managing the cash, deciding who gets credit, and handling all that big picture capital budgeting and financial planning stuff we just talked about. They are all about the flow of money. The controller, on the other hand, is more like the company's head accountant. This office handles all the historical financial data. We're talking taxes, cost accounting, and creating those official financial statements that tell the outside world how the company is doing. Okay, so we've covered the what, the how, and the who, but that leaves maybe the most important question of all, the why. Why do all this? What is the ultimate goal of all this financial management anyway? Look, a company can have a ton of goals, right? Surviving, beating the competition, making a profit, but the one guiding principle in corporate finance, the North Star, is this: to make decisions that maximize the current value of the company for its owners, the shareholders. Every single decision should ultimately be pointing toward that one objective. And that leaves us with one final and really crucial question to think about. In today's world, a world that's so focused on ethics, social responsibility, and sustainability, is just maximizing shareholder wealth really enough? Or should a modern financial manager be aiming for something more? That's a huge debate that's shaping the entire future of business as we speak.